Kitco Mining's special coverage of the Bank of Montreal's 32nd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.
Hello, and this is Paul Harris for Kitco at the 32nd BMO Global Metal and Mining and Critical Minerals Conference in Hollywood, Florida. Today I'm joined this morning by Daniel Earle, President and CEO of Solaris Resources. Good morning, Daniel.
Good morning. Thanks for having me.
It's good to see you again. Now, there seems to be a lot of love coming back into the copper exploration sector. There have been, I think, at least three $30 million bought deal financing so far this year, and a host of new exploration projects cropping up in Chile, British Columbia, Quebec, and elsewhere. This must be very encouraging for you as a copper explorer.
Well, I think it's encouraging for the industry globally. I mean, this is an imperative to go out there and find new sources of copper to feed into this energy transition, which is a kind of a global mandate now. And so I think it's very constructive from that perspective. From the Solaris perspective, we've never really felt the pressure of financing, but we're lucky to come from the Augusta Group, which has its own source of capital. Our major investor in this company is our executive chairman. He's invested nearly $200 million in the company. And with the strength of the project, we've always felt that we had ample access to capital, whatever we need. But it's good to see nevertheless.
Yeah, the investor appetite is certainly coming back. And within that, we're seeing in the critical metals space, we're seeing automotive and battery companies starting to invest in mining and exploration companies to get access to the battery metals they need. The copper, I would argue, is the more critical mineral of all of them. At what point do you think you'll start to see those kind of companies investing in the copper space, if at all?
Yeah, well, I agree with the sentiment that copper is the most critical over the long term. It's the metal that really wires together all these elements of the energy transition, and so it's the indispensable metal in that global transition. But I think that policy change comes out of crisis, and so the crisis, the security of supply panic that you saw in lithium that caused prices to basically rise an order of magnitude in a period of years, is what caused automakers to go out and try and invest in securing supplies, making investments directly in the miners and so on. And I think for copper, the depletion and exhaustion of inventories, depending on your economic assumptions for global growth, is still something like a couple, maybe a few years out. And I think when we get to that point and the market is screaming for metal, governments, automaker, end users, governments, and so on really understand the crisis that's facing copper supply, then that's when you'll see those types of investments in the copper sector.
But I'll be devil's advocate here with you, Daniel. Will we though? Because by the time the copper price gets there, all the major copper producers surely would have bought out all the up and coming developers such as yourself, and so there won't be anything left for the automotive companies.
Well, I think that's probably right. But I think the lead cycle for these projects basically assures that this deficit and the depletion of inventories is now locked in. Okay, so projects now take, from the time of discovery, more than 10 years to bring to production under the best of circumstances. And we've seen in various jurisdictions how that path to production can be complicated by a variety of issues. And so I think the outlook for copper in terms of structural deficits building, again, depending on global growth, where that point where those deficits begin to emerge is perhaps variable, but the end point of the depletion of inventories, I think, is certain this decade. So that's coming.
Okay, now we're starting to see mergers and acquisitions in the gold space, and the past few weeks have seen a number of transactions or bids announced. But with one or two exceptions, we haven't really been seeing that in the copper space. Why do you think that is, and what do you think it will take for the M&A to really heat up in copper?
Well, I think the broad architecture of metals markets and M&A markets related to them are basically hold from cycle to cycle. And so, obviously the M&A cycle operates at a lag to the metal price cycle. You saw copper bottomed in, towards the end of the first quarter of 2020. You're then looking at something like about an 18-month lag for M&A to kick off. And that's basically what we saw. We saw a series of transactions in late 2021. Obviously a market disruption in 2022 with a rollover in sentiment around global growth. I think what actually played out in terms of the physical fundamentals is that the copper market stayed tight. That's probably a separate conversation. But and that obviously impacted the appetite for M&A. But nevertheless, in the last year, we saw over $10 billion of transactions for Turquoise Hill and then for Oz Minerals. Again, the evolution of the M&A, the architecture of that remains the same from cycle to cycle. And so it concentrates on cash generative producing assets in the first phase of the market, and then transitions into a focus on development stage assets. And so the participants, it's the Western companies, the publicly listed, the majors, the diversifieds, and so on, and even the mid-tiers that dominate that first phase of the market. As we get into the second phase, then we all know that the Chinese, the SOEs, and the few private companies that exist in China are going to play a much larger role in that second phase. And I think the transition between the two is upon us here this year.
Okay, well, let's talk a little bit about copper prices. You sort of touching on it in your comments there. The copper price continues to be strong at around, currently about $4 per pound, which is historically a very high level. And it seems that perhaps people are sort of getting desensitized to that. It's become the sort of new norm. People are forgetting that, only a couple of years ago it was half that, and it was tough days for copper producers. It talked about there's a structural deficit coming. So what do you think will be some of the key drivers for the red metal this year?
Well, I think this year and beyond, you're basically at a high level looking at the same structural framework around the copper market. And so, the key elements of that are the rollover in legacy supply. So you see this most acutely in Chile. In a good year for pricing, as you said last year, you had Chilean production off something like 6% or so. And there's a little bit of growth to come. So we see QB2 is now in production. That'll be ramping up and contributing to some growth that helps offset this rollover in supply this year and next year. Beyond that, in theory, we may have some growth out of Escondida with an expansion there, but you've seen how cautious BHP has been on Chile with some of the changes that we're seeing in that jurisdiction, and Freeport and others. This isn't exclusive to them. Then you have Collahuasi expansion and Centinela expansion more towards the middle of the decade. But that's basically, the rollover in legacy supply. And then you're confronting demand where you've got two key components here. So the traditional end-use demand, which operates effectively as an annuity of something like 2.4%. So even in China, in their version of a recession last year, and this is representing about 50% of the demand side, copper growth, because the use intensity increases with the energy transition and so on, continues to grow. And then now, obviously, they're expecting that growth is going to rebound this year. People are talking about 6% growth, which would be a doubling of growth, which will just add to that growth pressure. Then you've got India coming in behind that. I mean, this is now the world's most populous country, a population of 1.4 billion people, an economy in terms of GDP that's nearing $3 trillion. It's virtually where China was in 2006, right in the meat of their really rapid growth period. Bit of a different economic model in terms of the composition of the growth that's expected, but nevertheless, you've got a country where you've got 2/3 of the population that exists below the middle class. And so you're talking about hundreds of millions of people that are going to join that middle class over the balance of the decade. And you can imagine, as they acquire shelter and housing, electricity demand along with that, build out in the grid to support that, appliances, the copper that entails, and then vehicles, the way that the copper intensity of that growth is going to increase in India. So I think in terms of the traditional end-use demand, you've got a very positive outlook. And then, of course, you've got this really rapid growth in the energy transition related demand, the so-called green demand. And this is driven by EVs, it's driven by renewables, it's driven by the build out of the grid and transmission capacity and so on to support that. And so it depends a little bit in terms of what your global growth outlook is. If you take the IMF expectations, they're forecasting global growth of about 2.9% this year. So that's a rebound in global growth, then 3.1% growth next year. If you were to be conservative and say that global growth will average about 2%, then the copper market should be in small surplus this year, balanced next year, and then in deficit the year after that, and for every year thereafter where the green demand really takes off. If growth comes in line with the IMF forecast, then we're in deficit already this year and every year thereafter. And so that'll bring forward the point where inventories are exhausted, and I think we really see fundamentally different pricing dynamics in the copper market, the way that we saw in lithium when you had a security of supply panic in that metal, and you see much, much higher prices in copper.
Well, I think it's a very interesting setup. You mentioned low inventories, the growth that's there, and bringing in the energy transition elements to that. There's a deficit of new projects to build. There's not a lot in the pipeline. The only thing that can really give, as you suggested, is the price. The incentive price to bring on new projects was it $5, $6, $7, $8, $10 per pound? If the copper price, as and when the copper price does get up to those levels, is there a lot of low-grade material at existing mines that's currently classified as waste that will magically become ore? And if so, how will that change the sector?
Yeah, well, you mentioned incentive pricing, and the rule of thumb that we used to use in the copper industry was something around $20,000 a ton of capacity to be brought online. And the kind of incentive pricing that you need to secure a 15% IRR is something in the high $3 range. Now, what's changed this cycle with the CapEx inflation that we've seen, this is a step change higher in terms of capital intensity. Projects like Teck Resources QB2 project, that was north of $30,000 a ton. And the incentive pricing there is in the high $4 range. And if you listen to Teck, they're saying to rebuild that project today would be a $10 billion project instead of a $7.75 billion project. So those numbers are actually headed higher in the future. And that's what supports much higher minimum kind of copper pricing. But obviously, if you believe that we're going to be looking at a stockout situation in terms of inventories, then that's really a fundamental change in the market dynamics. And that's when prices become unanchored by the kind of incentive pricing that you're talking about. You can see much higher prices in that sort of a scenario.
I think it's very interesting your comment there about what happened with QB2. I think their financial results this year was perhaps one of the first quarters ever that they weren't announcing a cost escalation. And their comment about, if you was to do it today, it would be 10 billion. I don't think there's many CEOs that would go to their board and try and get $10 billion to build a project. Self-survival, self-preservation. Nobody's going to end their career by trying to build a $10 billion project that's going to take 3 or 4 years and have that risk exposure for 3 and 4 years, which could go very badly.
Well, yeah, I mean, you can see that in the commentary that the CEOs of these major companies are providing, where they're sort of, they're still operating with, kind of stale numbers in mind. So, I think the CEO of Glencore articulated their kind of philosophy on allocating capital perfectly in the investor day that they had last year, where he said, we're going to wait to allocate capital and deliver growth until the market is really screaming for it. And that basically entails much higher, prices before they deliver that. And that's with stale numbers. I think if they were to update numbers to real capital costs as they exist in this cycle, the case would be even stronger for them to be conservative in terms of their capital allocation. So that's a theme that I think holds true across the industry.
Okay, and those comments were from Gary Nagel, of course. Now, copper deficit coming, pipelines, very spartanly populated, but Solaris with Warintza in Ecuador, you've got one of the projects that is going to be front and center to fill part of that supply gap. Tell us a little bit more about that. What were some of the key advances at Warintza last year, and what's the plan for this year?
Yeah, and just to be clear before we get into the outlook for the asset, we're in a different bracket than those high Andes projects. So that's one of the key features of the Warintza project. By virtue of the low cost intensity you have in Ecuador, with the infrastructure rich environment that you have, the low elevation, the grid power, which is hydroelectric power and therefore very low cost, the low cost labor, the free availability of fresh water, you're just at a much lower price point in terms of delivering one of these large scale projects. So whereas QB2, Teck would argue is a $10 billion project in the high Andes, that was a 51 million ton installed capacity. The project down the highway from us at Mirador, with the expansion project, will be a 40 million ton per annum project. So 80% of the capacity, but only $2.4 billion in total CapEx. So you're talking about more than a $5 billion capital difference. That puts us in a different snack bracket. It really alleviates the pressure that CEOs would be feeling in relation to the high Andes projects, which represents 40% of the global supply, and about that proportion of the outlook in terms of the pipeline for projects around our project. So it's really in a different snack bracket. The job for us, so we delivered a resource estimate based on about 18 months of drilling in April of last year. That was 1.5 billion tons at about 0.5 copper, with a starter pit of about 280 million tons at 0.8 copper. We've now done over a year of additional drilling since that point. We set out with the goal of basically doubling that starter pit, doubling the size of that starter pit, and then delivering significant overall growth, which essentially entailed drilling out the adjacent deposit, which is the East deposit. It was discovered late in the drilling program in support of that first resource, and it's now the focus of the resource drilling that we're doing here. So a large resource update, We've done internal technical program.
When will that be?
So that'll be in the second half of the year, together with an economic study. We've done a huge amount of work in the background in terms of technical programs. You saw the metallurgical results, very strong metallurgy, high recoveries for both copper and molybdenum, which is uniquely important in this market because you're seeing the crisis in the molybdenum market as well. Prices above $30 a pound. Yeah, exactly. So strong metallurgy, and then all the rest of the mine planning work and infrastructure work and looking at responsible solutions for tailings and waste and access roads and all the rest of it has been ongoing in the background, together with the permitting work. So we're trying to dovetail all of these various threads at the same time towards the end of this year. We'll have an EIA completed, submitted to the government for the permitting of the project, together with an economic study and a resource update to go along with it.
So final question for you, Daniel, this morning. We're at an investor conference. Your stock rocketed out of the gate when you IPO'd a couple of years ago. Last year, fair to say, it was an up and down year. What's going on there, why, given that you are one of the perhaps leading copper development stories out there?
Yeah, absolutely. So it's not unique to Solaris, but I think anytime you have a world-class discovery, the recognition of that in the market drives incredible shareholder returns. So we had more than 1,000% return for our investors in the first year and a half of kind of our existence as a public company. Anytime you put up that sort of a performance, you're vulnerable to a correction. And it's not only normal, it's actually the rule that you get a significant correction. Any world-class discovery that you look at, you see after that kind of a return out of the gate, something like a 50% correction. And then if you do have a project that delivers the goods, you're able, of course, to then recover that value and then crystallize it for shareholders if that's your strategy. And that's the history that you see play out within the Augusta Group with our prior world-class discoveries. Ventana Gold, which you know very well from your coverage of Colombia. Same thing, big run up, 50% correction, recovered the value, sold that for $1.5 billion in 2011. Same thing for Arizona Mining, different project, different jurisdiction, but the same pattern in terms of the chart, with a 50% correction, recover the value, sold that for $2.1 billion. We're dealing with that here with Solaris, and we're at the stage now where we've got a completely clean structure for the first time in 12 months. We've alleviated the structural overhang on our stock, which contributed to the sell-off last year. So it really exacerbated the move. If you look at the distribution from the unwind of the parent company's share position into the market.
This is Equinox Gold, yeah?
Equinox Gold, together with the warrants that were exercised and added additional pressure, you're talking about $150 million of additional selling on top of, the bear market correction that we had. And that would have been the largest share distribution on the TSX in the metal space, if you looked at the league tables and so on. And so that was the structural dislocation. We've alleviated that. We've cleared the overhang. We've got a clean structure to work with this year. And we've got a pathway in front of us to recover that value and then crystallize it ultimately for our shareholders.
Well, I wish you the best of luck. Daniel Earle, thank you very much for joining us today.
Thanks so much, Paul.
And I'm Paul Harris. Stay tuned to Kitco for more from BMO.
Kitco Mining's special coverage of the Bank of Montreal's 32nd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.